Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Victor Adair, co-founder of the Polar Futures Group. He's Senior Vice President and Derivatives Portfolio Manager at PI Financial in Vancouver. His website, polarfuturesgroup.com. Welcome back to the show, Victor.
Well, good to be back, Jim.
The U.S.-China trade talks came and went last week. Some people said they had a deal. China saying, no, we didn't. We want more talks. Now, we did see the U.S. stock markets have some rallies on that news. What is going on there?
Well, no, if you could tell me, then I'd know. Here's just some observations. I mean, the market may have breathed a sigh of relief. You know, that's sort of a cliche that the Chinese didn't just storm home and say we're done. So there might have been a bit of a relief rally here. Certainly running parallel to that, we had encouraging signs on the Brexit chaos that's been happening for the past couple of years, and we're getting down to the deadline on that, so we may have had a bit of a lift. And also, the news was out last week that the Fed was going to be putting money into the market via the repo market, and that may have also been a little bit of a buoyant factor. But, when you look at the stock market, I mean, what I see is, say, at the institutional level, the money managers of the world out there seem to have a higher than normal weighting to cash. In other words, they're kind of cautious, and some of the positioning within the market would look like they're cautious. In other words, they're not putting all their money in all the high flyers. But I was talking with my son last week before things took a run for the roses here, and I was saying, I think if this market was to trade up to new all-time highs, that would really surprise a lot of people. I think a lot of people are positioned for that to not happen. In other words, the institutional folks that I've just told you about. And certainly if you get on social media, it's like there's a whole cottage industry out there that says, the market is goofy, overvalued, you'd be an idiot to put money into it, and so on and so on and so on. And then there's other people that seem to want to buy every dip. So the market goes up and down, and I think sometimes you just have to accept you can't explain all these things. You just have to say, it is what it is.
With that kind of a market in place, how hard is it for people to plan their investments?
Real hard. I get it, especially, let's say, retired people or people that want to sort of draw income from their investments. You look around on the fixed income side, you don't get much there. You get a couple of percentage points if you're lucky on GICs and that kind of thing. And the stock market looks risky. I mean, anecdotally, when I'm talking to people out there, I get the sense that a lot of people are, as my grandma might say, are just sick and tired of the volatility in the stock market. They're scared to open their statement at the end of the month, so they're maybe opting to be a little more risk adverse, whereas other people may find themselves in a spot where, because they need to get some income, they're putting money in things than they should be. So, yeah, I hear you when you say it's difficult for people to do what they need to do in this environment, but again, it is what it is.
Although they're not calling it quantitative easing this time around, it sure smells and looks like it. The U.S. Federal Reserve planning to buy $60 billion worth of treasuries every month for the foreseeable future. What does that tell us about their plans and what's happening to the economy in both North America and Europe?
I think the narrative has been that the global economies are slowing. Okay, and there's certainly evidence to point that out in some places more than others. And let's say it's hard to look at the data that we get out of China and say you can make a judgment on that. But certainly, say Germany, manufacturing in the United States and other places around the world slowing down. We have seen the Fed cutting rates. A year ago now, the market was prepared for the Fed to be raising interest rates during 2019. So we've done a 180 since then. There seems to be, and I'm not going to try to explain or pretend I understand all the intricacies in the plumbing of the financial system in the States, but it seems there's been a shortage of money, so the Fed has been going into the repo market and putting money in there. I think all kinds of people are making a case that there's something really important happening there. Other people say it's no big deal. I tell you, I don't know. I just think that generally we've had a trend, not just with the Fed, but with other central banks around the world cutting interest rates because economies are a little softer. And, that's the pattern we're seeing, and that's showing up in the stock market. I think the stock market likes that in the current frame of reference here. And the bond market, up until recently, has liked that as well.
We'll have more with Victor Adair right after this.
Cypress Development Corp is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Victor Adair. Victor, the U.S. dollar index has recently traded to a 28-month high. On virtually all the interviews you've done with us in the past, you've been bullish on the U.S. dollar. Is that still the case?
No, I'm changing my mind a little bit. And yes, I have been sort of relentlessly bullish the U.S. dollar. The U.S. dollar has been trending higher, and certainly since, say, May or so of this year, it's moved up fairly smartly, although it's been a choppy rally, and it hasn't been, against everything. Some currencies have been weaker than others against the U.S. dollar, but I think the reason I'm kind of changing my mind a little bit has to do with the European Central Bank, and I'm beginning to wonder if they are, call it, done in terms of what they've done over the past couple of years with their quantitative easing, buying things, virtually everything there is in the bond market and that sort of thing, and if they're going to maybe not be doing so much monetary stimulus, maybe we'll start to see fiscal stimulus in the European area. It may also just be that, when you have a market that trends up from time to time, it has a setback and then, goes on and makes new highs. I do see the interest rate spread between the European paper and the United States is narrowing. It's still, the United States still has a premium over Europe, but it just feels a little bit that way. And the Fed, of course, seems to be going the other way. They seem to be wanting to step up their game in terms of monetary easing, and so maybe that will key the turn. Certainly, we know that the President of the United States would like to see the dollar weaker, and perhaps the Fed does too. If we, everybody knows the Fed's got a couple of mandates, and they want to keep unemployment low, and and inflation low. But I'm beginning to think they feel as though they got a third mandate, and that is to extend, the economic expansion that the United States has been on, and getting the U.S. dollar down would be helpful in that way as well. I say that thing about the President and the Fed because I always think in terms of where's the constituency that want something or would not stand in its way if it started to happen. So I am for my short-term trading, I've been probing, taking some short positions against the U.S. dollar. I've been buying the euro because maybe in a way that's been as beat up as anything. So if the trend is starting to at least have a correction, that's how I'm playing it. I'm not saying here that I think the U.S. dollar is going to fall like a stone or anything, but it's just had such a great run here. I'm thinking at least a correction at this point.
The Canadian dollar has traded in a very narrow range so far this year, around 75 cents U.S. Why do you think that's happened, and where do you think it goes from here?
Yeah, the Canadian dollar has been like watching paint dry. I think, from the beginning of the year till now, we've had about a 3-cent range between 74 and 77 cents, and the last 2.5 months, it's been in a 1-cent range between 75 and 76 cents. I think it's a bit of the teeter-totter thing. There are some things that would be bearish of Canada. Crude oil's down around $51. That's not so good. The U.S. dollar has generally been stronger. That is, say a strong U.S. dollar is not usually an environment where you find the Canadian dollar doing well. So there's that. On the other hand, Bank of Canada is one of the few banks in the major countries around the world that haven't cut interest rates. The interest rate premium that the United States had over Canada has washed away here over the past several months, so that we're, either side of break even between Canada and the United States. So that's been a Canada positive. But, who cares? Where do we go from here on Canada? We got the election next week. I think that'll have some impact. I think it would have much more of an impact, say, if the Conservatives pulled off a majority government. I think that would be seen as Canada bullish by the rest of the world that just kind of look, snap their fingers and say, what's your opinion? They would see that as being bullish. To see a minority Liberal government supported by NDP and Greens was probably what the market would expect. So if that happens, I don't think the bottom would fall out of Canada. And then, as I say, the big things that affect Canada, the relative strength of the U.S. dollar, I'm thinking it may weaken a bit here, so that maybe that puts a bit in Canada. The commodity market has been kind of weak, particularly crude oil, and that hurts Canada. So, I guess I just don't have a big opinion on Canada. I'll watch it from a technical perspective. It breaks out one way or the other, but right now, I think there's other things to follow that are more interesting.
We'll have more with Victor Adair right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Victor Adair. Gold has rallied nearly $300 since this time last year. It's dropped about $50 since last month's highs. Do you think the U.S. dollar may weaken and that may affect what's going on with gold?
Well, yeah, I do think the U.S. dollar could weaken here, and historically, a weaker U.S. dollar is bullish for the U.S. dollar price of gold. But look at it this way. I mean, a year ago, on the COMEX futures market, the speculators were net short of gold for the first time in more than 10 years. And here recently, that had changed to the point where they had an all-time record long position, valued at about $42 billion. So they had a huge swing from being net short to being along this amount of gold. The ETF market, that's the global gold ETF market, also here at all-time highs, around $130 billion. What I mean to say is that while that gold price rallied, and particularly since May, there has been a lot of people jump into the gold market. So, maybe that's a good thing. Maybe that shows the rally's got some legs, or maybe too many people came to the party too late and the market's a little vulnerable to backing up here if there was something that was going to be negative for the gold market. Now, another thing that I've observed is that while the gold market was rallying from November of last year to recently, call it September, so was the bond market. In other words, interest rates were falling. And, of course, everybody saw the headlines about $17 trillion worth of negative yielding bonds out there in the world. I think you can overlay the chart, the rally of gold, and also see this rally in the total amount of negative yielding bonds that's out there. I've seen those charts. I think, in other words, that the main driver of the rally in gold has been sort of the same thing that's been driving this rally in the bond market, taking interest rates down and down and down, particularly what we call real interest rates, which is what you get after you take the yield on the bond and subtract out the inflation rate. So falling real interest rates have been a very, or at least whatever's been causing that to happen, if not that in and of itself, I think has given the gold market quite a lift, or has been maybe the main driver for the past several months. And at this point, I'm beginning to think that interest rates may have also set themselves up for a correction, if not a major turn. I mean, we've had a 35, 38-year bull market in interest rates. Maybe it's run its distance. There's another thing, and that's called what we call geopolitical factors. We had that attack on the Saudi oil facilities last month, and gold really didn't do much. I think bottom to top, it rallied about $25, and 2 days later it was $30 lower. Let's say a couple of decades ago anyway, something like what happened there would have just driven the gold market crazy. And it just wasn't that big a deal. Now, the thing is, the event happened and there was no immediate follow-through for sure. There was no retaliation, so maybe no cause for gold to jump. I'm a little concerned here, basically, to cut to the chase, that gold's maybe overdone and could set back a little bit. One other thing I'm paying attention to here is the gold miners. So that's called, just look at the GDX ETF. As you can imagine, the share prices of the miners, gold miners, and the price of gold move somewhat similarly to one another. And those miners just traded down to a 2.5-month low here. So that may also indicate some softness in the gold price.
Crude jumped about $9 a barrel following the attacks on Saudi oil facilities last month, but it's fallen back below where it was prior to those attacks. In previous interviews, you've told us that oil and the stock market often go up and down together. With stocks back at near all-time highs, do you think oil might rally from here?
Yes, I have, and pointed out that relationship, and kind of one of the things I've got written down in my little book of notes that I made over the years is that relationships work until they don't. Yes, we've seen some, particularly, say, October of last year when the stock market was at its highs, gold was at its highs for the year, and they both fell down into the lows in December. They both turned higher in December and rallied from there. But it seems maybe lately that the relationship there is not as close as it once was. One of the things I've talked about with you in previous interviews is this supply-demand story, and how it seemed to me anyway that the market was really preoccupied with the supply side. In other words, the cutbacks in production from the Saudis, from the Russians, and what I call the Saudi, the OPEC and friends group. So now I think the market is much more fixated on demand, and with the slowing global economy, demand, the thinking is, and you see the International Energy Agency has been cutting back how much they think the world is going to demand going forward here because of the slowdown. So I think that's kind of been the drag on oil price, and has got it sitting down here at around $52, while the stock market is going up to new all-time highs. And just as I mentioned here about the gold shares relative to gold, you look at the energy shares, energy-related companies, whether they're producers or service companies, what have you, those stocks have been much weaker than crude has been, just like the gold stocks have been weaker than gold. So that may also be like foreshadowing that, we're not going to get the oil market to turn around anytime soon, save some wild and crazy event that causes a big supply shock. And one other thing to tag onto that, natural gas hardly gets the coverage that crude oil does, but natural gas prices have also been under pressure and are around multi-year lows here. So, that would also play into those oil stocks being under pressure.
You've actively been trading the futures market since the 70s. Do the lessons you've learned over the years still apply, or is it a whole new ball game?
Both, Jim. I mean, yeah, some of the lessons I've learned certainly do apply, and sometimes, of course, especially when you've maybe put together a string of losing trades, you think, I have no idea what I'm doing, and the old lessons don't apply anymore, and it is a new ball game. I think certainly information gets disseminated a way lot faster than it used to. When I was a broker in the 80s, before there was the internet, and if people wanted to trade the markets, they needed to go through a broker. The broker was the gatekeeper, for information as well as trade execution. Now, people don't need the broker for either one of those things, depending, at what level of experience you have and what you want to do. So there's that information gets out so much faster, social media and all that sort of thing. I think maybe time horizons are shorter. But then the things that never change over time, and people are people. Markets will go to extremes. People will chase markets, or people will throw up, their hands in despair at the bottoms, and, that's how bottoms are made. So, I think that kind of thing continues to happen. But in terms of some of the old rules I have, I've just come to believe more and more that I just really don't know that much, and nobody does. And if you think you know something about a market and you put a trade on based on what you think you know and the trade works, you say to yourself, well, I guess I was right about that. Well, you may have made money for reasons that had nothing to do with what caused you to put the trade on in the first place. So I'm really suspicious, and this is with my own trading, as to the quality of the information I have. So therefore, the importance that I would attach to my trade selection. In other words, let's say it this way. Everybody's got this idea, if you could just pick the right trade at the right time, you'd be that much further ahead. I'm going to say that your trade selection isn't anywhere near as important as what you do with the trade once you have it on. In other words, how you manage the trade. And I think I've known that since the 70s and the 80s, and that's still true. As I said moments ago, relationships change. I've always paid attention to relationships, but as much as anything, boy, once you figure out that, if A is going up, then B is going to follow it, well, just when you start to put a trade on that, A is going up and B just, heads off in a different direction entirely. So you have to pay attention to those relationships, but it's kind of like you can't count on them to be there. I could go on and on, Jim, but I'll tell you, I think trading today is, it's all screen-based. You really there are no more floors, so that is a huge change. But it is still a thing about you take a position, you manage your risk, and then you move on and sort of rinse and repeat, do it again.
Victor, thank you so much for chatting with us.
Jimmy, it's always a pleasure. Thank you very much.
My guest has been Victor Adair, co-founder of the Polar Futures Group. He's Senior Vice President and Derivatives Portfolio Manager at PI Financial in Vancouver. His website, polarfuturesgroup.com. If you have any questions for Victor or any of our other guests, you can send them to info@howstreet.com. Find us on Twitter @HowStreet. Our YouTube channel is Talk Digital Network. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.